Hey everyone, welcome to your final exam study session. I'm putting on my senior accountant hat today to mentor you through one of the most notoriously tricky standards out there, accounting for income taxes. Take a deep breath, grab your notes, because today we are going to completely demystify AASB 112 together and secure those top marks. Think of this explainer as your ultimate study tool.
Here's our game plan for this explainer. We'll hit accounting versus tax rulebooks, the balance sheet approach, mastering those tricky DTAs and DTLs, revaluations and equity impacts, and finally, adjusting for tax rate changes.
All right, let's kick things off with Section 1, Accounting versus Tax Rulebooks.
Okay, so the absolute core conflict you have to grasp for AASB 112 is this. The umpires for financial accounting and the umpires at the tax office? Yeah, they're using two completely different rulebooks. For your exam, you have to remember that your accounting profit is driven by GAAP, generally accepted accounting principles. That dictates exactly when we recognize income and expenses. But your taxable profit? That is strictly 100% dictated by income tax legislation. Because these two sets of rules totally disagree on timing and recognition, the profit you report to your shareholders literally almost never matches the profit you report to the tax office.
Here's a classic example examiners absolutely love to test: entertainment expenses. For your financial reporting, taking clients out for a nice dinner is a totally legitimate business expense. It naturally reduces your accounting profit. But the tax office? No way. They will never let you deduct that. It's a strict policy to stop businesses from subsidizing personal leisure and lunches out of pre-tax income. So this creates what we call a permanent difference between the two rulebooks. It's a real expense in your accounts, but it effectively just doesn't exist in the tax world.
Moving right along to Section 2, the balance sheet approach.
So how exactly do we fix this mismatch when it's just a matter of timing? Well, to bridge the gap between these rulebooks, AASB 112 requires us to use something called the balance sheet approach. Now, you need to contrast this with the taxes payable method. That method incorrectly assumes your tax expense is just whatever cash you happen to owe the tax office this year. I really need you to remember this for the exam. The taxes payable method is actually completely prohibited in Australia. Under the correct balance sheet approach, we have to systematically look at individual assets and liabilities on the balance sheet and compare their accounting values directly to their tax values.
To pull this off, let's nail down two crucial terms. First up is the carrying amount. This one's super straightforward. It's simply what your accounting records say an asset or liability is worth right now, based entirely on those GAAP rules we just talked about.
On the flip side, we have the tax base. This represents exactly what your balance sheet would look like if you prepared it strictly using taxation rules. It is literally the value the tax office assigns to that exact same asset or liability. And here's the magic: when the carrying amount and the tax base don't match up, bam, you've got yourself a temporary difference.
All right, on to Section 3, Mastering DTAs and DTLs.
Now pay close attention, because this right here is your ultimate exam cheat sheet for calculating deferred tax. This is how we actually turn those temporary differences into real journal entries. I want you to burn this formula into your brain for exam day. Your carrying amount minus the tax base equals your temporary difference. Then you just multiply that temporary difference by the corporate tax rate, and there you go. You've got your deferred tax asset or deferred tax liability. It's a highly mechanical process, but knowing exactly why it works is what's going to get you the top marks. Let's walk through some practical examples together.
Let's look at prepaid rent. In accounting, it's initially recorded as an asset because, well, you haven't actually used the office space yet. But for tax purposes, it's usually a deduction immediately when you hand over the cash. That means your accounting carrying amount is higher than your tax base, which is zero. This creates a taxable temporary difference. You essentially saved on tax today, but you are definitely going to have to pay it later when the accounting expense finally catches up. And that results in a deferred tax liability.
Okay. On the flip side, what about revenue received in advance? For accounting, this is a liability because you still owe a service to your customer. But the tax office? They typically tax that cash instantly, the second you receive it. So its tax base drops to zero. Here, your accounting liability is higher than your tax liability, which creates a deductible temporary difference. Because you already paid the tax up front, you get a future benefit, meaning you get to book a deferred tax asset.
Now, temporary differences aren't the only way to generate a deferred tax asset. Unused tax losses can create them too, but examiners love to trick you here with the probability test. You can't just recognize an asset for a massive loss willy-nilly. You absolutely must reasonably assume the entity will remain a going concern and that generating future taxable income is highly probable.
If the company is sinking, I hate to say it, but that tax loss is practically worthless.
Let's walk through the specific journal steps for a tax loss, because this is absolutely crucial. Imagine you incur a massive $1 million tax loss in year 1. Because you easily pass that probability test, you debit a deferred tax asset. Okay, fast forward to year 2, and you generate a $300,000 taxable profit. The key takeaway here is that your prior loss created a tangible economic benefit. So instead of physically paying cash to the tax office for year 2's profit, you simply credit that deferred tax asset to consume the benefit. You are effectively cashing in a giant tax coupon.
Moving into the heavy hitters now. Section 4. Revaluations and equity impacts.
Let's see how all of this builds when we introduce some of the absolute toughest exam curveballs, starting with asset revaluations. This is honestly where high distinctions are made. When you revalue a property upward, you naturally increase its carrying amount. But remember, the tax office does not care about your accounting revaluations. They base tax depreciation strictly on the original cost, so the tax base doesn't budge at all. This creates a massive taxable temporary difference. But here is the real trick. Because that asset revaluation goes straight to equity, specifically other comprehensive income, the resulting deferred tax liability must also be adjusted directly against equity. You take it right out of the revaluation surplus, not just your standard income tax expense.
And it gets even deeper. What if management actually expects to sell that revalued asset? Well, they might get a capital gains indexation tax break, which is essentially a nice little discount from the government for inflation. If that happens, the future tax you expect to pay actually drops. To account for that specific reduction in your journals, you debit a deferred tax liability to shrink it down, and you credit the revaluation reserve. Basically, the intended method of recovery, whether you are using the asset or selling it, fundamentally changes your tax base.
Almost there. Section 5. Adjusting for tax rate changes.
Okay, right here is where so many students trip up at the end of the semester. What on earth happens to the balances we've already calculated if the government decides to just change the actual corporate tax rate? Imagine, your existing deferred tax accounts were meticulously calculated over the last few years at a 30% tax rate. But then, right before you finalize your accounts, the government suddenly drops the corporate rate down to 25%. Overnight, those deferred balances you worked so hard on are essentially priced entirely wrong.
And this brilliantly illustrates the adjustment process. To fix it, you simply take your existing balance and multiply it by the new rate over the old rate, so 25 over 30. Let's say you had a $500,000 deferred tax asset. It instantly drops to about $416,667. That difference of $83,333, that represents lost tax savings. To record this, you credit the DTA to reduce it, and you debit income tax expense. You are literally writing down the value of your asset because the tax rate drop just made your future deductions way less valuable.
To truly impress your examiner and prove you don't just memorize rules, I want you to ask yourself this final thought. Do these deferred taxes actually meet the conceptual framework's strict definition of assets and liabilities? Think about it. An asset requires a present economic resource controlled by the entity. But with a deferred tax asset, there's literally no present physical claim against the government. You only ever get the benefit if you make future profits and if the tax laws don't suddenly change. It is highly conditional. Pondering that exact gray area is exactly what separates a good accounting student from a great one. Keep this explainer handy, study hard, and you're absolutely going to crush this exam.